We are Picturesque company. We produce cameras and drones. My name is Dylan Kleckner, and I'm in charge of compensation and facilities.
I'm Henry Taylor, and I'm in charge of finances and product design.
My name is Alexis Lopez, and I am in charge of marketing.
My name is Andrew D'Alessandro, and I'm in charge of corporate citizenship and special contracts.
The following presentation is reflective of our current financial and operative standing up to year 11, as well as our future opportunities in order to become a more efficient company.
Broadly, we focus on a differentiation strategy. We do have a slight preference for our drones. However, camera quality plays a large part in drone quality. Both our cameras and our drones tend to be above industry average quality. We aim to be the industry leader in quality products as well as in available models. This ties into our differentiation. The primary internal metrics we look at are PQ rating, number of models, and our operating profit margin. PQ rating and the number of available models are important because they tell us basically how competitive our product is. As we develop our models, as you know, PQ rating will go down. So the challenge that we face is maintaining a competitive PQ rating while also offering an above average number of models in both cameras and drones. Now, as far as cameras go, we tend to have a very competitive number on the market, but we don't always have the highest. However, in drones, we have the maximum number of drone models available, and we plan to add more camera models in the future to maintain an overall large above average number of models offered. The operating profit margin is also important to us because it basically tells us how much money we're actually bringing in per item, per unit, per region. Due to our struggle to gain market share and meet investor expectations in the early years, and our focus on our operating profit margins, factors such as price can vary heavily between regions and between years in order to maintain those profit margins.
Here you can see on the left is a graph of our earnings per share, our stock price, and our image rating. Our earnings per share has been below the demand of our investors due to our early commitment in R&D and trying to gain market share through PQ. These are both very expensive things, so we've been struggling, but we are consistently rising. Our stock price is also reflective of that. We had that huge commitment in the beginning of R&D and other things as well, which caused our stock price to not be so high in the beginning to whereas now we're finally gaining market share with our differentiated strategy, and it is helping our stock price rise steadily. Our image rating is above expectation due to our responsibility, our corporate responsibility, sorry, and our initiative in green donations. I believe we donate 4% of our operating profit into green initiatives, as well as provide our employees with the best facilities possible in order to have the best efficiency that we can have. Return on equity and credit rating are a little bit different in this respect. They've been strong in their own, in each of them. However, in year 12, you can see the jump, and that is due to a loan that has been taken out, as well as an increase in robotic manufacturing capabilities. Our credit rating is below expected due to the loan taken out. However, this is shown useful to us as we can see the jump in return on equity in year 12.
So now moving on to our year 11 matrix, or sorry, performance matrix. So you can see in these two graphs, we have both our investor expected and our actual for year 11. And it is noteworthy that our earnings per share had been lower than the industry average, primarily due to our historical losses in both Asia Pacific and Latin America. Additionally, the delay in repurchasing stock further contributed to the decline. However, it is noteworthy that our earnings per share has been steadily increasing since year 8. And as far as our return on equity is concerned, although we recorded higher net income compared to the previous years, our decision to take out the $119 million loan in year 11 to repurchase stock resulted in decreased shareholder equity. And with that being said, we are pleased to report that our return on equity has been on a steady upward trajectory since year 9. It is also important to highlight that the weakened credit score that we did receive can be attributed to the loan we took out in year 11.
Okay, and looking at the future outlook of our company, our investor expectations for our year 12 revenue was projected to be around 878,308. Our EPS for the next year is projected to be $8.50. The image rating is projected to be a 77. Our projected stock price is to be 250. Our projected ROE is 42.5%. And finally, our credit rating is projected to be an A. And in previous years, we have failed to meet some of our investor expectations, which can be attributed to our heavy investment in R&D and marketing early on. And our cost of goods sold has also been much higher compared to some of our competitors, which has ultimately affected our profitability. And due to the higher number of models that we do offer for our cameras and drones, it has raised our cost of goods sold, but in turn, it does differentiate ourselves from the rest of our competition, which is something we are looking for. The other reason for our cost of goods sold being so high is due to our high labor costs we had, and we have decided to implement robotic upgrades in the next year would be the best way to address this issue. While the initial investment may end up lowering our ending cash for the next year, we do believe that the reduced labor costs will help improve our cost of goods sold. And currently we are maxed out on drone models, but in the upcoming years, we are going to try and increase the number of camera models we have to further differentiate ourselves from the rest of our competition. We have already been consistently meeting our image rating expectation in previous years, and to continue to do so, we'll invest in corporate citizenship as needed. And then finally, in future years, we plan to spend an increasing amount of our ending cash on share buybacks just to ensure we are meeting our investor expectation on earnings per share, which in previous years we have failed to do so.
Thank you for giving us the time and listening to what we hope will help lead us into the future with ferocity. We are Picturesque. Thank you again.